SoFi is currently trading at $27.87, which is a significant move up of 73 cents, marking a 2.69% gain on the day. Now, the easy analysis, the one you'll get from most places, is that this is just part of a broader risk-on sentiment in the fintech sector. But what the surface-level data doesn't show you is the subtle but important shift in institutional order flow we've seen in the pre-market and the first hour of trading. There have been several block trades that suggest a larger fund is accumulating a position, not with aggressive market orders that would spike the price unnaturally, but with patient limit orders absorbing shares from sellers. This isn't the chaotic retail buying you might see on the Robinhood app. This is calculated, methodical accumulation, and it suggests a different story is unfolding behind the ticker price. This is where the real work of analysis begins, moving past the headlines and into the mechanics of market movement. This kind of nuanced activity often precedes a more sustained move, but it is by no means a guarantee. The common belief surrounding SoFi is that it is the ultimate financial disruptor, the much-touted one-stop shop for all things finance, destined to take significant market share from the old guard. The narrative is compelling. A single, user-friendly mobile app where you can refinance your student loans, get a personal loan, buy stocks and crypto through SoFi Invest, and manage your daily banking. This is the expectation, the story of a seamless digital ecosystem that will attract millions of young, high-earning consumers away from legacy institutions. It's a powerful vision, one that positions SoFi to become the Amazon of personal finance. Many who are looking for investment help or want to self-invest online are drawn to this promise. But the operational reality is far more complex and challenging than this polished narrative suggests. The truth is that SoFi is fighting a multi-front war against incredibly well-capitalized and deeply entrenched competitors. For every service it offers, there is a specialist who does it better or a giant who can do it cheaper. Its SoFi investing platform, for instance, isn't just competing with other fintechs, but with the vast resources of Fidelity, a behemoth with a trusted brand and a comprehensive suite of tools from Fidelity brokerage accounts to complex Fidelity wealth management services. When you consider the competition, the picture becomes less about disruption and more about a costly battle for customer acquisition and, more importantly, customer loyalty. Let's break down the recent stock movement with more detail. Today's 2.69% climb is occurring on volume that is tracking about 15% above its 30-day average for this time of day. This indicates a higher level of conviction behind the move than we've seen on other recent up days. The stock has been attempting to establish a new support level around the $26 mark for the past 2 weeks, and today's price action is a strong test of the resistance near $28. A close above this level could signal a potential breakout, attracting technical traders and momentum investors. However, we must also consider the broader market context. While the NASDAQ is up, other high-growth tech names aren't seeing the same level of buying pressure. This suggests today's strength may be more SoFi-specific, possibly linked to renewed optimism about the impact of the full resumption of student loan payments, a core part of its original business. This is a critical factor for SoFi, as its ability to convert these student loan customers into users of its other financial products is central to the bull thesis. The real test will be whether this momentum can be sustained in the face of macroeconomic headwinds, like persistent inflation, which could impact its members' ability to take on new loans or invest through its platform. Investors looking at various investing sites need to weigh these company-specific catalysts against the bigger economic picture. The competitive environment cannot be overstated. When a user opens an individual brokerage account, they are faced with a dizzying array of choices. There's Robinhood, which, despite its controversies, perfected the art of the simple, commission-free trading experience with Robinhood stock trading and Robinhood fractional shares, attracting a whole generation of new investors. On the other end of the spectrum is Interactive Brokers, whose Interactive Brokers platform is the gold standard for sophisticated traders who demand advanced tools and global market access, even if the interactive broker's fees are structured for more active participants. Then you have the established titans. Fidelity offers an incredibly robust ecosystem, from its widely used Fidelity mobile app to its extensive selection of Fidelity ETFs and Fidelity mutual funds, catering to everyone from beginners to high-net-worth individuals managing their Fidelity IRAs. SoFi is trying to carve out a space in the middle, offering a bit of everything. Its SoFi active investing platform is functional, but it lacks the professional-grade tools of interactive brokers. Its SoFi Robo-Advisor provides a simplified, intelligent portfolio experience, but it's up against established products like Schwab Intelligent Portfolios. The central question for investors is whether SoFi's all-in-one convenience is a strong enough value proposition to pull users away from these specialized and trusted platforms. This isn't just a hypothetical, it's a real-time battle for assets under management and user engagement. It's a fight that costs a tremendous amount in marketing and promotions. To fully grasp the company's position, you have to understand its structure. SoFi operates through three distinct segments. First is lending, which includes student loans, personal loans, and home loans. This is their legacy business and a primary driver of revenue. Second is the technology platform, powered by its acquisitions of Galileo and Technisys. Galileo provides the back-end infrastructure for many other fintech companies, processing payments and enabling core digital banking functions. This is a business-to-business play that provides a separate, diversified revenue stream. Third is the financial services segment, which is the consumer-facing suite of products like SoFi Invest, SoFi Money, their checking and savings account, the SoFi credit card, and more. The strategy is to create a flywheel, attract customers with a competitive loan product, then cross-sell them into the broader financial services ecosystem, increasing their lifetime value. The acquisition of a national bank charter was absolutely essential to this strategy. It allows SoFi to fund its loans with low-cost deposits from its SoFi Money accounts rather than relying on more expensive wholesale funding markets. This directly impacts their net interest margin and is a key driver of future profitability. The performance of this synergy is one of the most important metrics to watch in their quarterly earnings reports. Looking toward the future, the bull case paints a very attractive picture. The expectation is that the flywheel strategy works flawlessly. Member growth continues its impressive trajectory, and more importantly, the number of products per member increases quarter after quarter. The technology platform, Galileo, becomes the undisputed leader in fintech infrastructure, akin to what Amazon Web Services is for the cloud. The student loan business provides a steady stream of high-quality leads, and the bank charter allows SoFi to expand its margins and achieve sustained, high-quality profitability. In this scenario, the stock's current valuation could look very cheap in hindsight, perhaps even mirroring the trajectory of growth names like a younger Tesla stock or Nvidia stock. Comment below with what you think is SoFi's single greatest competitive advantage: its brand, its technology platform, or its bank charter. However, we must ground this optimism in reality. The bear case presents a number of significant risks. First and foremost is the brutal competition. The big banks are not standing still. They are investing billions into their own digital platforms. Giants like Fidelity and Schwab have immense scale and brand trust that SoFi simply cannot match overnight. Second, a severe economic recession would be a major headwind, potentially leading to a spike in loan delinquencies and a sharp drop in demand for new loans and investment products. Third, the path to consistent GAAP profitability could be longer and more challenging than the market currently anticipates. High spending on marketing and stock-based compensation has weighed on the bottom line, and investors will eventually want to see a clear and sustainable profit. Finally, there's execution risk. Integrating acquisitions like Technisys and scaling the banking operations is a complex operational challenge. Any stumbles could erode investor confidence and put pressure on the stock. This is the reality that balances the optimistic expectation. An investor looking for online investment opportunities must weigh this potential against these very real hurdles. In summary, the story of SoFi is a classic case of high expectations meeting a complex reality. The 2.69% pop in the stock today is encouraging, but it's a single data point in a much larger and more complicated picture. The popular narrative of SoFi as the inevitable conqueror of traditional finance is compelling, but it glosses over the intense competitive pressures and the significant operational challenges the company faces. The reality is that SoFi is a promising company with a strong brand and a smart strategy, particularly with its bank charter and technology platform. However, it is operating in one of the most competitive industries on the planet, fighting for every customer against giants like Fidelity and nimble specialists like Robinhood and Interactive Brokers. Understanding the tension between the ambitious vision and the on-the-ground battle is absolutely essential to making an informed decision about SoFi as a long-term investment.